Hi and welcome to Swissquote's Daily Market Talk. It's Thursday, September 26th. Nasdaq futures are up this morning following strong forecasts from Micron Technology. Yesterday, US indices consolidate near their all-time high levels before today's US GDP update. Then the OECD says that the global economy will do just fine this year and the next, and particularly for the UK. Alas, oil bulls are not buying any of it. So the global economy is settling into a newfound stability, and central banks can continue to cautiously cut their interest rates, said the OECD yesterday. But not with their eyes closed, mind you. They cautioned that the major central banks should maintain their data-dependent approach and be prudent while they're cutting their interest rates. We are all looking at you, Mr. Jerome Powell. But anyway, one thing that actually stood out in that OECD report yesterday was the group's projections for the UK economy, because their economist said that the UK will grow more this year and next year than previously forecasted and print the best performance among the group of G7 economies just after the US, and that despite a sticky inflation in the UK. And the UK's sticky inflation is just one more reason to believe that the Bank of England will keep the pace of its interest rate cuts in the UK slower than the peers. Both improved prospects and the cautious Bank of England stance are supportive of the pound sterling, mind you. So cable traded past the 1.34 level yesterday at the highest level since spring 2022, and the euro pound trends understandably lower these days with the diverging fortunes and the diverging outlook for the UK and the European economies, especially with Germany, that's under pressure these days and that must carry out reforms according to the OECD report. Now, the only thing that could eventually get on the way of the sterling bulls these days is maybe the upcoming autumn statement, which could pour some cold water on this enthusiasm that the new Labour leadership in the UK will strengthen the back of the UK's shattered economy post-Brexit, post-pandemic, and post-energy crisis. Why? Simply because the government needs money to boost spending and boost growth, and everyone is quite curious to see where the money that's necessary to fuel growth in the UK will come from. Now, the good news is the UK's government knows very well what not to do to get investors angry, because we will be celebrating the second anniversary of Truss's mini budget crisis this October. But anyway, coming back to sterling, the outlook for the British pound remains positive against both the US dollar and the single currency. And coming back to the OECD report of yesterday, Japan and Canada are also expected to do well next year. So voila, that's pretty much the global outlook. Now, interestingly, the upbeat outlook from the OECD, the rising tensions in the Middle East, the 4.5 million barrel dive that we saw in US oil inventories last week that actually pushed the US oil inventories to the lowest levels in 2.5 years, and all the stimulus measures that China announced throughout this week did little to cheer oil investors up. The US crude slipped below the $70 per barrel level yet again, and the barrel of crude remains under a visible selling pressure this morning at the time I'm talking here. And we also know that investors continue to trim their net speculative long positions in crude oil, and that despite very much supportive price factors out there. So inability to pull out the $70 to $72 per barrel offers this week could increase the chances of a fresh attempt on the $65 per barrel level in the coming weeks. And besides oil, the stock markets weren't in a particularly bullish mood at yesterday's trading session either. Investors apparently preferred moving toward the sidelines and leave the S&P 500 and Nasdaq hang near their all-time high levels before today's GDP print from the US and before tomorrow's core PCE read from the US as well. Now, remember that the US economy is expected to have grown by 3% in the second quarter, and Atlanta Fed's GDP forecast now suggests that the growth may have remained robust near that level in the third quarter as well, which is obviously great news for those who bet that the Fed will eventually achieve the soft landing that it dreams of. But it will also make investors think twice about their expectations for the next Fed meetings. Because look, activity on Fed funds futures currently assesses more than a 60% chance for a second 50 basis point cut from the Federal Reserve in the November meeting. And there is nothing, at least in the economic data front, that would justify such a move besides just greed. So I think that a sufficiently strong GDP read from the US has the potential to bring the bulls back to the market after one day break and send the US stock markets to fresh all-time high levels. But too much strength in the economic data should, I think, at some point in time, encourage a scaling back of the Federal Reserve's dovish expectations and lead to a consolidation and maybe, but just maybe, a minor downside correction in the US stock markets and also the global stock markets. But for now, well, we all agree that the bulls have an undeniably stronger grip on the equity markets, because Nasdaq futures are also up this morning at the time I'm talking here, and that on the back of surprisingly strong sales and profit forecast from Micron Technology, thanks to a good AI demand, which actually maintains supply lower than demand, as the company apparently sold out of a high bandwidth product for this year and for next year. So Micron shares surged nearly 15% in the after hours trading yesterday, and the post-earnings rally in Micron should help the stock price return above its 200-day moving average and eventually secure a floor near the $100 per share psychological level. Now, zooming out, the AI fatigue gives signs of dissipating as the Federal Reserve boost gives a fresh room to breathe for AI-related stocks, as obviously part of global boost to risk appetite altogether. So Nvidia extends gains with joy above the 50-day moving average, while VanEck Semiconductor ETF held ground near its 200-day moving average recently and is simply drilling above its 100-day moving average this week. In the FX markets, the US dollar rebounded at yesterday's trading session against most majors, but the outlook for the greenback remains negative, as the global central banks or the Fed's global peers keep their dovish bias as inflation eases globally, without, however, feeling the urge to boost their economies and their economic growth before making sure that inflation goes into a deeper sleep. So the euro dollar retreated yesterday after testing levels above the 112 resistance. The dollar yen is flirting with the 145 level this morning, and the dollar franc consolidates a touch below the 85 cents level before the Swiss National Bank decision this morning. Now the SNB will have probably cut its rates by 25 basis points by the time this video comes to you, and that's already priced in. But what will continue to drive the dollar franc prices is, the direction of the US dollar, which should eventually consolidate and see a minor rebound in the short run. I think with the expectation that the market and the Federal Reserve members will come back to their senses at some point regarding their overly dovish monetary policy outlook. But in fine, in the medium to long run, the broadly negative dollar outlook, which is also due to this exploding US debt, is expected to keep the Swiss franc and other major currencies and also gold well supported against this troubled greenback. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.